Hi, this is James Eng with Full Capital, and this month's webinar I'm titling Seeking Stability. So for November 2024, let's just jump in right from the beginning. So, what does that mean, seeking stability? This is a quote from CEO of Walker and Dunlop, which is one of the agency lenders out there. Um, and he said on his third quarter call, it's really more the consistency of rates, which allow people to determine the cost of capital and thus their cap rate. And so the market's going to adjust to whatever this new number is. But, his point is that it's been very challenging over the last 2 years to determine cost of capital and thus an accurate cap rate. So his opinion, the stability in rates is far more important than the aggregate rate number. So in summary, consistent 10-year treasury, you determine your interest rate on your loan, and that's what you're willing to trade at. And so, using that as a backdrop of sort of what the market's thinking, what they're seeing right now, um, here's the 10-year treasury, right? And, when the first rate cut by the Fed was in September, everyone thought rates are going to keep going down. But it's done the opposite, right? So in this hypothetical example, $1 million NOI at 5% is about $20 million value, and that's on cap rate. But then if you started, let's say you got under contract when the Fed first cut in September, you had a $12 million loan at 525, and then right now where 10 years sitting, you have $11.4 million loan at 5.75. So it's moved against you significantly, very quickly in the last 30 days. And so that's more equity, that's a lower return. And so a lot of people are going back up to this guy and saying, hey, I thought I was only going to be 25 basis points negatively levered. Now I'm 75. And so this bid ask spread keeps moving around. And so that's what they're really talking about in terms of stability. Um, so that's just one example of what we're going to go through today on today's webinar. First off, we're going to talk about sort of what closed, right? Because a lot of these deals, it takes time. It's taking longer for Fannie and Freddie to get through deals. So we're going to talk about sales and DFW. We're going to hone in on sort of how deals are getting done in terms of their financing. We're going to talk about foreclosures, and then we're going to talk about earnings calls, lenders, owners, what they're seeing out there across their entire portfolio nationally. And then we'll talk about financing and what we're seeing in that market. And so this deck is pretty long. So if you want a copy of the deck, just email me. Here's my email, jeng@oldcapitallending.com, and I can send you a PDF of this deck. All right, so let's just jump in. So this is DFW sales in Q3 2024 so far, are already occurring, and you can see it in the green is really discretionary. So I would think of that as like A plus, probably 2010 and newer. Upper mid range is probably 90s and newer. Um, so of the 62 properties that sold in the third quarter, probably about 40 to 50 of those almost were sort of in that A minus space. And so if you say, all right, let's say the workforce, sort of your probably B minus C stuff is in orange. There's maybe, one, two, three, four, five or six balloons on here out of 60. And so you can see what's trading right now is really your A stuff. And there's a couple of reasons for that. One is institutional money is back and they're deploying into multifamily. That's one. And two is the cap rates aren't as far off, right? So if in the peak, let's say cap rates on A stuff was 4.5 in DFW, and now they're at 5.5, it's not that far off. So there hasn't been a lot of value loss in that space, and so a lot more people can transact and pick up a gain on their equity, especially if they bought sort of pre-COVID. A lot of the workforce stuff, if they bought it in 21, 22 at a 4.5, 5 cap, and now you're having to trade that stuff at 6 to 7 caps, there's a lot more value loss. And so a lot of those people just aren't willing to go right now if they don't have to. So let's jump in to some of these sales and talk through some of them. So, I mean, just looking at, all right, so this is in somewhat alphabetical order. So, Um, it's not in one direction or another in terms of rationality, but just looking at like the first four, so all agency, all 5-year term. So you're going to see that consistently throughout deals that have closed. A lot of people are going shorter on their term, thinking that rates are high right now, and they don't want to get stuck in some sort of a large prepayment penalty. And if rates come down, they can either refi or sell that property. But let's take this deal. We'll try to, highlight a couple of deals on each page. 3,800 on Portland and Irving. Um, so the seller's loan was in 2021. It was a $28 million bridge loan from Bridge. And the new person coming in by it, they put a $20 million Freddie Mac loan, 5-year loan on it. So essentially, you don't know 100% what the sales price was for the seller when they bought it in 21 versus what they're selling it for in 24. But you can make a pretty good estimate of what it is. So we're seeing a lot of deals trade essentially right at the bridge loan amount or a little bit higher. And so, assuming 65% leverage on maybe an A deal, on a B deal, you're maybe 75% levered almost. Um, Take that and you pretty much get there right at the bridge loan amount. So that's where a lot of these deals are trading now, is at the seller's loan amount, especially on the B and C stuff. Some of these other deals, let's go down here. So this is a Freddie Mac 10-year. So on some of these deals, people are going a little bit longer, especially on newer deals. And you can see this one, it's listed as Dallas Housing Finance Corp. So you're seeing a lot of these tax exempt deals coming through now. Um, it's getting a little bit, there's two types of, uh, tax exempt deals. One is you doing it in the county that your property's in, and then also some where people are doing it with a county that's outside of where the property is. And so the ones where you're doing it with the property, like this one is in Dallas County, and you're talking with Dallas Housing Finance Corp. We're seeing those get a little bit more streamlined and higher probability of going through. All right, so let's go to the next page. So this is an interesting wrinkle, especially on the BNC stuff. So you can see this deal in Dallas to Bryant, it was a B deal, but it was 65% occupied, right? And so the existing owner, they had a bridge loan at $33.6 million, but then, um, you know, they can't really sell it for that amount. And the lender doesn't probably want to take over the property either. So they're bringing in a new general partner right from the beginning. So instead of the lender foreclosing and trying to run the asset, they're swapping out these GPs. And so on this deal, Tides owned the deal in 2022. Uh, it looks like Tides got foreclosed by the lender. And then within like 1 month, they were like, okay, we're going to sell this deal and give it to a new GP, but, we'll help you with the financing. And so um, the existing lender is, they did a $33.6 million loan in 2021, and now in 2024, all right, another $33.6 million loan. So they're almost just like you know, getting these people, it's almost like seller financing to some extent, is that they're letting these people, general partners, get in there, try to improve the occupancy, try to refinance them out, because the existing GP is just not able to work that deal anymore. And then let's see. This other deal, Carly on Frankfurt, that was a deal that was under contract for a while. Looks like the occupancy was a little bit lower than 90. But you can see that in 2021, the loan was 36 million and now it's at 30. So another case of reset basis. All right, now going to the third page here, you're seeing this same thing, non-recourse bridge lender, and they're essentially swapping out the GP. The occupancy is close to 78% on this deal. Same thing down here, 76%, both these deals in Lake Highlands. And on these non-recourse bridges that you're seeing being done, um, it's almost swapping out a GPs, whereas, the stuff that's going Fannie and Freddie, those are just sort of normal arm's length transaction deals. And, on these three right here, it's 5 year and 7 year term. And on some of these deals, you know, we try to do our best to research these transactions, and we talk to brokers, but a lot of these deals, people are just closing all cash. And so, in order to give certainty of close to either the seller, or they need to get something done by year end, or they have a 1031, we're seeing some deals, especially even Class A deals, get closed all cash, and then people are going to put on financing later. So if there's a lot of volatility in the market, they're just waiting on some of that stuff. Um, Here you see a majority of these deals were Fannie and Freddie, or all Freddie. These were all Freddie. And then three of the four were 5 year terms. And then another A deal was life insurance. And then it doesn't really say, but Equity Residential bought this portfolio. And most likely they probably closed all cash. All right, next page. So a lot of these deals also Fannie Freddie, and then we see non-recourse bridge, and this was the same lender. They did a $21 million loan in 2021, and now they're doing a $19 million loan for the new buyer. So a lot of times, obviously you can take a deal out to multiple bridge lenders, but sometimes going back to the exact same lender, they're going to cut you the best deal on that transaction because they want that new general partner into that deal more so than the existing general partner. All right, here's some additional ones. You can see that some of these were Fannie and Freddie, others non-recourse bridge. This was a life company, loan assumption, bank loan. If it's under 90%, it becomes harder and harder to get these deals done. So you're seeing non-recourse bridge and bank loans. So both of these, 75% and 78%. This was a portfolio sale, this deal in Grapevine. And then another example, this is a deal in Lake Highlands, same thing, bridge to bridge. And then this one, we haven't really gotten a ton of information, or hasn't been in the news that much, but this was a deal in Duncanville. And in 2019, there was a $13 million loan against it, agency. And then in 2022, there was a $35 million loan. So imagine going from $13 million agency loan to a $35 million agency loan on the same deal in less than 3 years. And it's only 122 units. So something's off there, and ended up getting foreclosed on. And so I think they're going to start looking at these transactions and underwriting a lot more in detail, in terms of especially when there's such a large difference between the loan amount that you're paying off and the loan amount that you're getting. Here's a couple of deals to wrap up Q3 2024. Fannie Freddie, again, this one was seller financing because of the occupancy. And then, this one also was a tax exempt deal in Denton. And then I also pulled, just because we're a little bit into fourth quarter, a little bit, we brought in some other deals that that have closed already. You can also see mostly Fannie and Freddie, some loan assumptions, some tax exempt deals. This one was under 90%, so with non-recourse bridge. But on this deal, you can see it was tax exemption as well. And then I'm trying to see. So most of these, Fannie and Freddie, life insurance, and then same on this one. So that was really the sales Q3, Q4 across DFW that have happened, or recorded so far. Now let's jump into the foreclosures. And in DFW, there really hasn't been a ton of foreclosures. A lot of them have been specific to one or two groups. This one is really around GVA. So GVA was based in Austin. This one was Tides. And then there's a couple more in Tides that they just did not. I think they tried to go out and raise some preferred equity, but just couldn't do it in time. And these lenders are taking these properties back. especially with occupancies, at 60 or 40%. I mean, there's just not much cash flow to sustain these deals. This was one short sale where essentially it was the bridge loan done in 21, 22, and now the lender is willing to take, a lower amount than the loan amount. And so that's one of the first ones that we've seen here in DFW. In San Antonio, they've had a few foreclosures as well. And then, so this was Lumet who foreclosed on this one. And then in Houston, we've seen more. So, this was across one, two, three, four, five or six properties. And then what we're seeing is some lenders will take the property back and then run it for a little bit, get it stabilized, and then take it out. And then other ones are going pretty quickly after they foreclose. They just don't want to hold it anymore and they're taking it to market. So this one was listed. Um, Western Wealth was a group that had bought a lot of properties and they were on bridge loans. And so they had to sell some of their properties at a loss. And now we're seeing that they actually received sort of a recap where they came in, a new entity came in to buy interest rate caps, put up interest reserves, and sort of not help kick the can, but some of these deals, the lender needed you to buy an interest rate cap. And so, in order to do that, you could go back to your initial investors. But if you haven't given them distributions, it's going to be hard to get additional money in terms of a capital call. And so, a lot of general partners are having to go out and raise money from a new source in order to keep these deals going. And so that's what Weston Wealth did out of Phoenix, I believe, or they had a lot in Phoenix, and then but they're based out in Canada, I think. But as we see more and more listings and um, you know, everyone's trying to peg a cap rate on where these deals should trade. And so, brokers are now advertising the cap rate a little bit. This deal was out in I think San Antonio, yeah, Northwest San Antonio. So this was a 70s deal at an 8% cap rate. And so I don't think it's gone that far north in DFW, but maybe in your smaller markets throughout Texas, especially in your BNC stuff, it's going to start creeping up there in order to move some of these deals. Okay, so we talked about deals that have traded, some of the foreclosures that have happened in Texas, and now let's get into sort of the forecast of where federal funds is going to go and its impact. So in September they had a 50 basis point cut. This month they did 25, and now everyone's expecting. So it's sitting right here, 450 to 475 federal funds rate. And everyone's expecting one more cut in December and then maybe two more next year. So you're ending up sort of your terminal rate is about 375. And so that's the plan right now. That's what everyone's forecasting. But obviously it can change quickly. So Pinsford, who does a great job, put together a couple slides that I thought were interesting in their last webinar. And they talked about, when the Fed does cut, it is essentially a recession signal, right? They are trying to balance inflation, growth, and unemployment. And so if you look at a couple of these, like the last five, um, on average, the first cut, on average, it's been about 5 months, 5 to 6 months before the recession arrives. So in 2019, it was 6. 2007, it was about 2.5 months after they cut. 2001 is about 2 months. 1989 was 12 months. So the only time it was verted is in 1995. So you're trying to sort of watch capital markets thawing, but then you don't want the economic situation to deteriorate anymore. Um, so if you look at the federal funds rate, this was pretty much every time they cut. Let's just look like the last 25 years. So, in 2000, 2001, they cut, and then you head into a recession. 2007, 2008, they cut and head into recession. And so we're right here at the very end of this thing. And, we're 75 basis points into it. So we'll just have to wait and see. Everyone's thinking, it could be a soft landing, or, this thing might cut a lot deeper than expected if the unemployment rate starts moving up. So, um, but there's a delayed reaction on the unemployment. So this from Pinsford again, that usually unemployment doesn't start rising until about 6 to 12 months after the first cut. So, that implies, if we're sitting at 4 right now, then you might be at 5.5, 6% by next year. All right. So one other report that came out in the last month or so was Yardi, which puts together a lot of uh, data on multifamily, and you know, this is where it all really starts. For is on the supply side and the amount of supply that's hit in 2024. This is a peak, so I think you got to go back to like the 70s or 80s to see 550,000 units delivered. And 2025 is still going to be a lot of units delivered. But 2026, it basically comes back down to normal. So you're gonna have to, um, you know, I think some of this is trended. So some of the 2027 looks like it's the lowest, going back to maybe 2014, 2015. And for now, this is just muting, rent growth across the portfolios. Houston, Dallas, Austin. Houston being okay because it really hasn't been hit too much with supply. Dallas is down, -1 or 2%. Austin, I think it depends on the submarket, but it's down 5 or 6% on rent growth. It's worse in some submarkets. And this is really the thing that is everybody has been hitting on is that um, even though it's the interest rates have hurt multifamily in terms of ownership groups, it also has hurt people going out and trying to buy homes just because the cost is so much higher compared to renting. And so this gap, I've seen anywhere from 700 to 800 to $1,000 difference per month of owning versus renting. And so it's just a lot harder for people to jump up to this ownership side. All right. So, let's get into some of the quarterly calls. Um, this month we're going to talk about. I just pulled out three of the quarterly calls and just sort of walk through them. So Arbor is a Fannie Freddie lender, and for them they did a ton of bridge loans, and they're calling this right now the most challenging part of the cycle. And they are a little bit more positive, especially the last 60 days where cap cost came down, 10-year came down to like 360. Everyone's feeling pretty good. And but then yeah, 10-year popped up to 425, and that has changed the tenor. So it changed that quick, right? So everybody was good. Everyone thought, the Fed's gonna cut. 10 years coming down to 3.6, 3.7. But it's changed very quickly, and now they're like, oh, might be a little bit challenging if the 10-year doesn't come down for the fourth quarter. Um, they modified close to 1.2 billion in loans. They wanted about 3% in new equity, so that's probably to buy interest rate caps. And some of these loans that they modified, some people didn't have the money for interest rate caps, and so they just had to adjust their. So it could have been most of these deals are like SOFR plus, let's say 3.5. So you're still all in at 7 to 8%, and some people just can't pay it, and so they had to adjust the pay rates on some of these deals down to 6% and said, look, you pay a 6 current, and then this 2.5% we'll put on the back end. And so your balance is increasing um, so that you just pay it off at the end. And they had to do that on about 60% of the loans. And they have about 1 billion in loans that they're just going to either have to keep modifying or bring in new sponsorship. So you can see we saw in the transactions that they were bringing in new sponsorship on these bridge loans, and that's what Arbor's doing as well. So they had 945 million in delinquencies, and that's down from 1.5 billion in June. And then they actually had to take back about 77 million in REO for the third quarter, and they're expecting another 250 million that they're going to have to take back. And so if they just can't work out a deal or just can't switch out the sponsor, then they're gonna take it back. But you know, even though they have $1 billion in delinquencies, they are ramping up their bridge lending program again. They think if you buy at a reset basis, if you buy at a good cost, and then, the rents come back in 25, 26, 27, your bridge loans should be pretty safe. And so they still did $1 billion in agency loan originations. But, the agencies got backed up, right? So when 10-year came down 60, 70 basis points, everyone submitted for refinances, acquisitions, everything. And the agencies were just not ready. And so we saw backup on Fannie and Freddie as well. All right, so Walker and Dunlop, similar to Arbor, but they typically did not do bridge loans, so they're really more on the agency side. Um, they were definitely more bullish that this is the beginning of the new cycle, and they sell properties as well. So they, in Q2, they had about 1.5 billion in Q2, and then they jumped up to 3.6 in Q3. So definitely seeing the market pick up in the third quarter. They mentioned cost of home ownership is unaffordable for many Americans as well. And they're, like everybody, this construction cost is just keeping the market down in terms of undersupply. And then, you know, every nobody loves that you have to go in and buy these deals at sort of neutral leverage, right? Like what we talked about in the very first transaction, where the cap rate is essentially five, and now you're having to put on debt at 525 to 575. And um, you know, why are people buying at that point? And it really comes down to this, right? So they have a conviction of rents that are going to move in the next 2 years, and because of the lower supply. And so that's what's really driving the investment sales today. Um, and they feel it's starting right now. So in terms of financing, they mentioned, Fannie and Freddie, they have about 140 billion to put out, and so far they've put out 68 billion. So for the fourth quarter, they got plenty of money to lend out, but the question is, can they get through it all to really get it out? But borrowers have been picking the 5 year, which we saw sort of through the transactions. Um, and, even though 10-year Treasury we had at about 430 right now, um, his perspective, the CEO's perspective was really like, look, the last 12, 13 years have been really low on rates. And as soon as, people figure out how to work with these and sellers are willing to accept these values, deals will get done. And, he pointed back to 2004 to 2007, that 10-year, this yellow highlighted section right here, the 10-year treasury between 2004 and 2007 was between four and four and a half. And so plenty of deals got done. You're probably, putting on debt at 6 to 6.5, but your cap rates were significantly higher. And so I think that's what has to change. This consistency of rates is going to allow people to figure out sort of really where the market is. All right. The last um, quarterly call that I'm going to discuss is really Camden. So Camden owns probably 50, 60,000 units throughout sort of Southeast, Southwest. And the first thing they touched on was, look, all this stuff being higher, houses, mortgage rates, taxes, insurance, is actually helping us. And people are not moving out. And so the new apartment supply is hitting a 50-year peak. There's limited rent growth now, but starts are going to go down, and rents will start picking up here in 26 and 27. And this is the thing, they thought more transactions for sure are going to be coming, but then on the acquisition side, they really leaned into they're okay, instead of developing, they're okay buying below replacement costs just because it doesn't have lease up risk. And a lot of people are starting to sell, especially merchant builders. So a lot of the merchant builders, they have what's called a pref return, and then they have to pay that out. And, throughout the longer they hold these deals, then they're basically having to pay this pref. And so their profit's going down. So if you don't think you're going to make significantly more, you might as well just go now, because they have to pay out their pref, and almost all that pref is coming from when you actually sell the property. And so that's why we're seeing more of these deals selling really on the A side. Uh, you know, Whereas somebody who just owns the deal and it's cash flowing, but it's a B to C deal, B and C, Class B and Class C deal, they don't really have to sell right now if they have an agency loan in place. Austin, Nashville, they said we're definitely the worst in terms of supply right now. And Camden's a huge REIT, and they looked at a lot of deals, and they're like cap rates on A stuff right now is like mid fours, so not five, not five and a half. So they're seeing deals just because the number of buyers in the market for A stuff and the amount of money that needs to go out, that's pushing those cap rates down. And so there's been that's almost it's almost like a self-fulfilling prophecy to some extent. Like someone lists a deal and it goes out, and the brokers gives them a BOV at 5 to 5.25, and it sells at 475 or 465 cap. And then now more sellers come to market, and then they keep going selling more and more A stuff. But in order to really get the returns, Camden, as everyone says, they're conservative. They underwrite conservatively. Um, they're like, look, in order for you to hit your returns, you almost have to put in, like, you can't just plug 3% rent growth in years two, three, and four. You have to put outsized growth. So what that means is 4 or 5, 6% rent growth in some of those years, to really make the model work, right? So you're making a little bit more of a bet above average rent growth in those outer years with the lower supply. And in terms of operations, and this is why it's hard to underwrite some of these deals, is you know your new leases are still going down, right? So your lease trade outs are coming down. You're at 2.8%. Renewals are up based on their existing base, but their new leases keep trending down. Expense growth about 2%, and suburban is doing better than urban. And this last piece, usually they have about 15 to 20% of their tenants, Class A tenants, move out to buy houses. Right now, it's about 9%. And then in terms of development, it's still hard to develop because construction costs have not come down, but the rents have come down. And so if it costs you the same to build it, but your rents are coming down, it's pretty hard to get development done right now. They are starting some. They have 320 million for this year and about 375, but it's a relatively small dent, right? So if you think about these guys have, I'm not going to say unlimited capital, but plenty of capital to deploy, and they're still not starting developments. I mean, this might be, two or three properties. Um, the merchant developer is not going to start properties if if financing is expensive, the banks won't give them money, then construction is not going to pick up right now. All right, that was a lot of information, so thanks for hanging in there with me and going through it. And for sure, send me an email if you need the slides and want to run through it. But my background, born and raised in Houston, went to school at UT in Austin, and have been up here in DFW since 2006. Underwrote a lot of different types of commercial properties at GE Capital for 2007 to 2015, and then since 2015 have been at Old Capital, focused in on multifamily as a lender and investor. All right, so I mean, we went through some of these transactions, but you can see that where a lot of these deals are getting done are really this middle section, Freddie and Fannie. Rates in the third quarter dipped down, which helped a lot of transactions. But now it's a little bit more challenging in the fourth quarter. So we're seeing rates. Freddie Mac SBL has probably moved up the most, 6.5 to 7.25. Freddie Mac and Fannie Mae probably about 5.5 to 6. Non-recourse bridge, you're probably dipping down. Maybe you're at 7.5 to 8.5, 9% right now, just depending on the size of the deal and then what your leverage point is on that type of stuff. Bank loans, this is still happening, but it's really smaller deals, probably 1 to 5 million. This is a deal we closed in sort of North Dallas. Bank loans are going to be 3 to 5 years, going to be fixed rate, and then it's going to have almost no prepayment penalty, but you're going to have to bring some deposits over to that bank in order to get it done. Freddie Mac SPL, we just closed this deal in October. So this, it's moved up, right? So you can lock the rate at loan application, but it's moved up pretty quickly following the movement of the 10-year, right? So it's now 6.5 to 7. Um, but this is gonna, once you sign the loan application, it's gonna lock the rate. And this is probably like your lowest costs, right? Like you can get into a deal at 10 to 15,000 on the loan application and have your rate locked and sort of can move down the road through your loan process. But they are Freddie Mac like Fannie is taking some time to get through these deals. Uh, Freddie Mac conventional, similar process. These are for 7.5 million and higher. We're seeing deals, especially on the 5 year side. They've been a little bit more aggressive on the 5 year term, get done. And, this is for experienced borrowers, 7.5 million and higher. And then Fannie Mae, so this was a loan that was on a floater, Fannie Mae floater, and they had to decide, okay, do we take it to fixed rate or do we just buy another interest rate cap? 10-year treasuries came down, and they basically could, instead of buying the interest rate cap, they could just do like a cash neutral refi into a fixed rate loan. And so we're seeing a lot of those. And so we've got a lot of those teed up. And when the 10-year gets closer to 4 or under 4, people I think will probably move on that a little bit quicker this time around. They had a shot sort of before the election, and now I think if they see that again, they're going to move a lot quicker. Non-recourse bridge, SOFR plus 3.5 adds more and more, like the way that Arbor was thinking about it, as more and more people get into the bridge lending space, that's going to narrow that spread down. And so you might be able to, 3.25 on larger deals on non-recourse bridge, especially if there's, a pretty straightforward path to getting to, an agency loan in 2 to 3 years. Here's some of the loans that we closed over the last year. Mostly Fannie Freddie, a couple non-recourse bridges out there. And YO Capital, so O Capital is a mortgage broker, and through all these cycles, right, over the last 10 years, whether people have been going with bridge, people are going Fannie Freddie, HUD, we represent you throughout the transaction. We sort of educate you at the beginning, teach you sort of the ropes of this business, and then sort of walk you through the process, whether touring deals, connecting you with vendors, working with you throughout the entire sort of acquisition, refinance, loan process, and then helping you sort of with your asset management, whether having you on the podcast or your conference or just or at our conference, helping you throughout the process is why people use us. Some of the events, so we just finished up our conference. We had about 450 people over at the Bush Library in October. And then we have a couple events coming up. If you want a link to the registration, you can just email me. But this one is coming up this week. It's a lunch and learn, a little bit more informal than the conference. Don't wear a suit to lunch and learn. And then in January, we're going to do a field trip that we're calling it. So a bus tour. We'll meet over near the airport and basically go look at properties that we financed and give you a feel for, class A, B, and C here in DFW. So number one, subscribe to the channel if you haven't, just to get updates on this and upcoming, deals coming out. Like and comment, share this video. If you need help with an upcoming loan maturity, feel free to email me, T12 rent roll loan agreement. If you need a term sheet, similar stuff, T12 and rent roll. And I'm happy to look at any packages or just get people started, right? Because what we've seen is that a lot of people are entering the market right now. So they were, they felt like it was too aggressive in 21 and 22, and they were sort of on the sidelines. And now those people are coming back into the market. And so if you want to get, set up, get your PFS, REO, get your stuff ready so that you can buy deals in the future, feel free to send me an email on that as well. So appreciate you guys watching. Thanks. Bye.